there's certainly a lot of interest in investing in and lending to, even buying law firms these days. It's an exciting market.
I mean, it's interesting you should say that because, of course, every time we open the news, every time we listen to a politician, they would have us believe that we're entering into a period of unprecedented doom and gloom. But from what you're saying, Mark, it sounds like there's reasons for optimism if a professional services business, a law firm, actually wants to get involved in growing the business or selling the business. It sounds like there's causes for optimism there.
I think that's absolutely right. A good friend of mine taught me a new word 2 weeks ago, which is bifurcation. And when I looked it up in the dictionary, what it tells me is that for good opportunities, there's lots of money out there. And for the average or less well thought through opportunities, they'll struggle to raise money. But yeah, it wasn't a word I was familiar with. But the gist of it is there's so much money out there. Present a compelling opportunity in the right way, and that's our job to help you present it right. There is more money than ever out there, and that's debt as well as equity.
Well, let's start there, Mark, because I must agree with what you've just said about the business's story and their plan being presented in the right way. Because before I met you, I tried with no assistance or advice to raise substantial capital for about 3 or 4 years. And I was getting nowhere, I must admit. And the reason for it is it wasn't so much that Spire Group presented an unpalatable opportunity for lenders. It was that issue that I just wasn't presenting the numbers in the right way. I wasn't presenting the story in the right way. And I mean, presumably, because it's what you do for a living, you would support the idea that getting the right advisor at the outset was very important if somebody wants to, if a law firm wants to raise capital.
I think so. An experienced advisor knows what the market is looking to see, looks at the proposition through the funder's eyes. So it means that when they do open the document or sit down, it's something they're expecting to read, and it ticks their boxes, if you like. I think it's also, we have a number of disciplines, things we need to see, things we need to explain that are obvious to us, but not necessarily obvious to the guy running a business. And maybe that's where you hadn't been clear on one or two areas. But we managed to raise money successfully for you. Lovely business. It was during COVID, though, so it wasn't the easiest at times, but we got there and we got it done, as you recall.
Well, you really did. I mean, that wasn't the only challenge, although it was a pretty significant one. I think one of the, maybe one of the positives, but also maybe a slight negative with Spire Group, and I know with many groups, is that we have different service lines within the structure. And they do complement each other at a certain level, but it does need a lender who's prepared to look at things with that same element of diversity, rather than just look at like a one size fits all approach. Is that something you've come across in the past in terms of making sure that you find a lender who's going to be comfortable with that diversity in the portfolio?
I think most lenders are reasonably comfortable with some diversity, but it does lead to complications. Number one is it's important to be crystal clear what your market proposition is, what it is that you're trying to be, what you're trying to do. And when you've got 6 different divisions going in different directions, that's not always the easiest, particularly if you start off by saying we do 6 different things. So it's, we're about this is what we do. And there are a number of different facets to that, but that's what we do. It's the elevator pitch. It's not rocket science. It's going back to the beginning of selling any story. It's keeping it simple to start with and hooking the audience.
Well, this is where I was struggling, to be honest with you, because typical lawyer, I think I was approaching discussions with lenders on the basis that they would be as interested in the detail of my business to the same degree that I was. But I think what I learned pretty quickly is if you can't describe what it is you do and what you're trying to achieve in sort of 2 or 3 minutes, then it's probable that a lender's going to start losing patience. Is that right?
Lost patience, lost interest, yes. It's a story, it's catching their attention. It's not a disclosure letter at this stage. That's what it looked like to me at sometimes. Um,
Yeah,
Covering
well,
every piece of detail so as not to be caught out later. No, it's about storytelling.
that's right. And I mean, in terms of the elevator pitch, what is it? What is it that you're trying to get over to the investor in the short period of their interest that you have? Is the investor thinking at that point, is this a business which is secure? Is it one, is this a business I'm going to get my money back from if things go wrong? Or are some investors more interested in the really exciting stuff? You know, how growth can be accelerated, how scale can be achieved. What's pushing and pulling the investor at that early stage?
Okay, I think there's two things there. One is, if it's a debt investor, they're more interested in certainty and security, and an equity investor needs to know the excitement and the growth. But there's two real things I'm selling or wanting us to sell to start with. One is the market proposition. What are we doing? Who are we doing it for? Why are we special? The second part is the growth plan. What are we going to do to grow value over a period of time? So that's what I want to sell. Because I'm then talking to investors and bankers, they're then thinking, oh, lawyers, okay, so they've got a partnership. No. We then clarity about leadership, performance, and that we understand the quality of our earnings. So those are the hygiene factors. And we've all worked in partnerships, and that's not a business model that's ideal for investment. So we need to calm people down about that. Performance, yeah, we may be a law firm or a legal services firm, but we've got up-to-date management accounts. We budget, we measure against that, we check our KPIs. Quality of earnings is then understanding, this is maybe not quite such an obvious one, but it's understanding there's a difference between recurring, contracted possibly customers and income versus a business like mine, which is event-driven. It's a company sale. So if you're looking at a law firm, an M&A lawyer is probably not the securest form of income. So those are the issues we try and calm the investor down around at an early stage. And there's one reason why we do that. It's funny, you talk about recession, there is lots of money. What there isn't any more of is time. So investors are generous with their money, but very mean with their time. So unless you hook them early to say, this sounds interesting, and it sounds like they know what they're doing, they're not going to invest their time in your opportunity. And what we're asking for is, please spend some time with us so you can understand what a great opportunity this is. And that's the theme of the market at the minute, spending that time.
And that goes back to your point, isn't it, about having your elevator pitch, your story in as succinct a fashion as you possibly could. But it was interesting because what you've moved on to there is a bit more of the detail if you are able to hook the investor's attention. I mean, you've gone through there the issue around quality of earnings, growth, leadership, which I want us to pick through. But I was fascinated by what you've just said about the partnership model, because when I was in a partnership, one of the problems you had from the get-go was that what tends to happen within professional partnerships is you have a group of people who are all of different ages. And because the partnership is quite a clunky, a clunky vehicle to lead in terms of decision making, then the various financial aspirations of the different partners can really get in the way of decisions being made, either about the fundraise itself, or when you get down to brass tacks with an investor, if they think that you're going to have to go through 5 layers of bureaucracy to get a decision on anything, that can be a massive turn-off. Is that your experience of how investors view old school style partnerships in the legal sector?
Absolutely. And I speak as someone that's worked in 2 big accounting partnerships over the years. The number one turn-off for an investor that will stop them looking very early on is, we have to put decisions to a vote. Anything that puts things back to the partnership. So unless you've got devolved authority to a leadership group or a CEO, as we had at KPMG and Grant Thornton before that, unless you have that devolved authority, it's going to make life very difficult for all but the most basic of debt lending. I don't think it crosses out the debt lending, but certainly in terms of equity investment and significant growth, it makes life difficult, I think.
Yeah, and I mean, I think there's a really point here for anyone listening and watching who perhaps doesn't have that devolved authority within their organisation. You really do need it, and I'm talking about a wider issue here than just raising capital. Effectively, if you're leading a business and you have not got that devolved authority to make decisions on behalf of the business, then leadership becomes impossible. And indeed, I wouldn't be prepared to lead a business or a group where I couldn't make decisions within a pre-agreed mandate. And again, we're back to this issue of partners. I mean, remember when I was in a partnership in a law firm, sometimes you needed 4 partnership meetings to decide what colour you were painting reception. And that's not a recipe for entrepreneurship. And I mean, it must be even more of an eyes rolling moment for an investor.
Absolutely is. And if you think most investors that we're talking about in this environment are private equity, they're not public equity, and private equity is all about quick decisions and getting on with things. Whereas if you do anything you recommend or want to do with a public company, it has to go to a shareholder vote. That's much more like a partnership. And if you can't convince everybody, so it's just anathema to the private equity investors in particular. I think debt funds and banks for lending, it's slightly easier to cope with a partnership model, but never equity.